NVIDIA's earnings are out today. Now, look, we've had a lot of discussion at this ETF conference last week about the concentration risk in the S&P 500 and the importance of diversification. The RIAs, the investment advisors, they were beset by investors calling up saying, oh, why am I not more in the Magnificent Seven? Or why am I too much in the Magnificent Seven? So how does Schwab think about this? What do you tell your investors?
You know, we really talk to them about using a combination of cap-weighted and smart beta. We have a lineup within our offering, the Schwab Fundamental Index ETFs. They select and weight constituents by non-price measures. So therefore, you're not as highly concentrated to those Magnificent Seven. But when you combine it with market cap, you kind of get the ebbs and flows. You get the momentum from the market cap. You get that better diversification.
So be more specific. You're saying use.
They select the securities in the index based upon non-price weighting. So they think about earnings and fundamental factors.
Like quality stuff.
Exactly. Yeah. In which case, you underweight those momentum-oriented securities that can be a counterbalance to traditional market cap.
Do you have a quality ETF? This sounds like you're describing that.
I mean, it's not a quality. That's the Schwab Fundamental Index ETF. So we've got a suite of
those. What's the symbol for that?
We've got several of them. FNDF is our international, which is one of our larger ones in that space.
Yeah. So do you agree with this, Nate? I mean, the diversification issue was a big topic last week. And so what was funny was to watch the panel on this tie themselves up in knots saying, essentially, no, you shouldn't be throwing a lot of money into Magnificent Seven, but as an alternative, sell your clients on momentum, MTUM, or sell it on quality, QUAL. And these are ETF symbols we're throwing out, folks, here. And it was funny, Nate, to watch everybody sort of tie themselves into knots trying to say, well, there's proxies that you can use for the Magnificent Seven that aren't exactly the Magnificent Seven. So does this all make any sense? It seems diversification risk is a genuine issue.
Yeah, I think there are two very important points to be made here. I mean, you look right now, the Magnificent Seven stocks comprise nearly 30% of the holdings in the S&P 500. So 7 stocks represent 30%, which is about as concentrated as we've seen the S&P 500. But the points I would make here are, one, this is what you sign up for when you invest in market cap weighted indices, right? It's important to remember that investors who have been invested in the S&P 500 have received the benefit of this concentration as stocks have powered higher. So that's obviously a positive. Now, on the other hand, to what David was hitting on, look, I don't think there's any question concentration does present some risk here. And there are different ways you can approach it. You can look at smart beta ETFs. From my standpoint, I just think the overall diversification in a portfolio is critical. So we have mid-cap stocks, small-cap stocks, international stocks. It's not necessarily shun market cap weighted indices. It's to make sure you don't have everything in the S&P 500.
I am not as worried as everybody else. First of all, this has happened in the past. This 30% number you keep mentioning. In the late 90s, there was an intense concentration, same way. And even with the Nifty 50 70 years ago, I think the top 10 stocks were close to 30% of the S&P at that time. So this is not unprecedented. The great thing about owning an index is it self-corrects eventually. You partake in the advances of the Magnificent Seven. If other stuff, equal weighted stuff, starts moving up, you will participate in that, even if you're in a market cap weighted index. So I am not as worried as everybody seems to be.
And Nate makes a really strong argument for the case for diversification.
Yeah.
Right. Not only the S&P, but mid cap, small cap.
You are diversified in the S&P, though. That's the point.
But also looking back at rebalancing your portfolio when it gets out of whack. Understanding what is my strategic allocation? How do I
want to get
there?
a second topic in before we got to go here, and that's guess what? Spot Bitcoin ETFs. Of course, you can't go by a week without mentioning that. So we've had what, 5 billion, Nate, in inflows in 5 weeks. So we've had these 10 spot Bitcoin ETFs. They've been successful. They track well. But I characterize the flows. To me, the overall flows seem still fairly modest. Much of it is coming out of Grayscale and going into the other ETFs, Bitcoin ETFs. Your thoughts on this, Nate?
Well, I would counter that a little bit. I mean, you look year to date, 2 spot Bitcoin ETFs are in the top 8 of all ETF flow getters this year. So the iShares Bitcoin Trust, IBIT, that's number 3 in inflows, and then the Fidelity Wise Origin Bitcoin Fund, ticker FBTC, that's 8. But as you were saying, overall, spot Bitcoin ETFs have now taken in over $5 billion in net flows in just over 5 trading weeks. So that's 9 new ETFs that have taken in over 12 billion because the Grayscale Bitcoin Trust has had over 7 billion in outflows. In my mind, I don't think there's any way to characterize that as anything other than a monumental success. Again, 5 trading weeks, 5 billion in net flows. Now, what happens moving forward, we'll see. But a lot of these ETFs are just now getting approved on various platforms. I think advisors are just now getting comfortable with these ETFs. So I think there's a positive, pretty strong tailwind behind this.
What was interesting to me at this, listening to the conference, was half of the RIAs seemed very interested. The other half seemed terrified of the legal consequences. You know, Gary Gensler fired a shot across the bow at all of these people when he conceded the Grayscale case and said, "May I remind all you people out there, you RIAs, that you have reg best interests that requires suitability requirements, and that means you better be darn careful about selling Bitcoin to grandma, as I like to call it. You could potentially get sued there." So I'm sure some of the RIAs I talked to were clearly uncomfortable with what's the legal requirements for me to follow. This is new. We don't know, right?
And where does it fit in a portfolio? Talk about diversification. Where does it slot in?
Yeah.
What's the right percentage, if it is the right allocation for a client?
Well, what about Schwab? You guys haven't done anything, right? Is there any consideration?
Well, I can never comment on what we may be considering in the background. What I can say is we'll do the same thing we always do, and that's put the investor first. Understand what the investor needs are, take that in, and that guides our product development.
What are you reading from the Charles Schwab playbook or something here? Did you memorize that sentence? I've interviewed Charles Schwab. I know him. That's exactly what Charles Schwab would say. You sounded like Charles Schwab over there.
Well, it's high compliments then.
Go work for Charles Schwab. Oh, wait, you do work for Charles Schwab.